The last industry we're going to look at is the maritime industry. We're going to look at Hornbeck Offshore Services, Cory Holdings, Tidewater Incorporated, Gulfmark Offshore, and Halliburton. In terms of liquidity, all 5 firms were able to cover their current liabilities with their current assets, which is a big accomplishment when you compare them to the other 2 industries, because only a couple of the firms in other industries were able to do this. Cory, Tidewater, and Gulfmark have enough cash on hand to cover their liabilities, which I didn't necessarily see as a good thing. I see some of that cash can be used for investments to increase their revenue in the future. So I see them as just wasting their money by just letting it sit around. Hornbeck and Halliburton were the most attractive because they had enough assets to cover their liabilities, but also had enough cash to generate more revenue instead of letting it sit around. In terms of long-term solvency, the equity multipliers are actually pretty low compared to the other two industries, as well as the equity ratios. The maritime firm, Cory had the highest equity multiplier, which shows they're trying the most to increase their revenue with leverage. Halliburton and Hornbeck had nearly identical capital structures, so it was pretty difficult to associate or disassociate the two in terms of the long-term solvency. In terms of asset management, Hornbeck and Halliburton both have total asset turnovers that are much higher than the other firms. So we definitely like those better than Cory, Tidewater, and Gulfmark, which had relatively low total asset turnovers. In terms of profitability, Halliburton had the highest average return on assets and return on equity, which is a good sign for investors. Hornbeck is also doing well in terms of profitability, lagging just behind Halliburton in profit margin and return on assets, and a little bit more for return on equity. The oil spill affected all the firms' profitability in 2010, but especially Halliburton, which were the ones who were actually blamed for causing the spill. Tidewater and Gulfmark have high profit margins, but it's not translated into a high return on asset or return on equity, which raises some concern for investors. In terms of market value, the market has the most confidence in Hornbeck and Halliburton, because as you can see with their market-to-book ratios of 2.26 and 2.27. The price-to-earnings ratio for both firms were well below the industry average of around 18. Tidewater was the closest to the industry average, but Gulfmark and especially Cory are overvalued. All 3 firms have low confidence from investors when compared to Halliburton and Hornbeck. The best maritime firm, in my opinion, was Halliburton. They had high liquidity and it's using their cash well. They tied for the highest total asset turnover among the maritime firms. They have a high confidence from investors and the highest average return on asset and return on equity, as well as an improving profit margin since the oil spill. As you can tell, their economic value added is actually in the negative $277 million. It was in the middle when compared to the other firms, but none of them really had a very good EVA. In terms of supply chain, forgot what I was going to say. Their biggest supplier was Carbo Ceramics, and as far as customers, they're not getting a lot of revenue from their customers. In my opinion, the best firm to invest out of Exelon, CBS, and Halliburton was Halliburton. Their current share price is $44.12 per share. I expected the price of share to be at least $50 in a year. The reason I picked Halliburton is they had the highest average and 2012 return on equity out of the 3 firms, which means they're the best at converting stockholders' equity into revenue. They also are a very large company that is very well diversified, thus reducing the risk of investing in the firm. They were able to recover well from the oil spill, which is more significant for them than I saw as any of the other firms in the maritime industry, because they were the ones blamed for the oil spill. So not only did they have to lose, they lost the revenue from just the oil itself, but also the public relations nightmare they had with being the ones that caused it. They actually found that the improper cementation of the well a week before the spill was the cause. Halliburton's dividend payout has risen at a consistent rate over the last decade and was not affected by the spill or any other controversies associated with the firm. So I saw that as a great sign that even when bad times happen, that they still have their investors in mind. Thank you.